Have you ever pondered how financial frauds are detected and prevented? The answer lies in the fascinating world of forensic accounting. This specialized field of accounting is akin to a blend of detective work and financial analysis. Forensic accountants, often touted as financial detectives, are equipped with the knowledge and skills to comb through financial records and uncover irregularities that may suggest fraudulent activities. But their role extends beyond mere detection. They also work to prevent fraud by identifying potential vulnerabilities in a business's financial processes and recommending remedial measures. And then we have the intriguing concept of fraud examination. This is an investigative process, often led by these forensic accountants, that seeks to resolve allegations of fraud from inception to disposition. It's not just about finding the culprits, it's about understanding how they beat the system. In essence, forensic accountants are financial detectives unraveling the mysteries of financial discrepancies and misconduct. Financial fraud, often known as the invisible crime, can have devastating effects on businesses. It's a dark underbelly of the business world, a specter that looms large over any financial transaction. But what exactly is financial fraud? At its core, financial fraud is a form of deceit or trickery that affects the financial health of businesses. There are three main types: asset misappropriation, financial statement fraud, and corruption. Asset misappropriation, the most common type, involves the misuse or theft of a company's assets. This could range from a simple act like a cashier pocketing change to complex schemes like payroll fraud, where ghost employees are created to siphon off funds. Next, we have financial statement fraud, which is less common but far more damaging. This involves manipulating financial statements to present a healthier picture of a company's financial position. This might involve inflating revenues, underreporting expenses, or even hiding liabilities. Lastly, we have corruption, which involves unethical behavior like bribes, kickbacks, or conflicts of interest. This type of fraud can severely tarnish a company's reputation and can lead to hefty legal penalties. The impact of these frauds is immense. They can erode trust, damage reputations, and even lead to the downfall of companies. On a larger scale, financial fraud can destabilize economies and lead to financial crises. Take, for instance, the housing bubble burst in 2008. At the heart of this crisis was financial fraud, with many financial institutions misrepresenting the risk of their mortgage-backed securities. The fallout was catastrophic, leading to a global recession. So you see, financial fraud isn't just an issue for businesses, it's a societal issue. It's a game of cat and mouse, where fraudsters are constantly evolving their techniques to outsmart detection systems. This is why the role of forensic accountants is so crucial. They are the detectives of the financial world, using their skills to uncover fraud, expose the culprits, and hopefully, prevent such frauds from happening in the future. The invisible crime of financial fraud can cripple businesses, making the role of forensic accountants vital in today's business environment. The Enron scandal, one of the most notorious cases of corporate fraud, is a prime example of the importance of forensic accounting. In the late 90s and early 2000s, Enron, an American energy company, was considered one of the most innovative companies in the world. However, beneath the shiny exterior was a complex web of deceit and corruption. The company's top executives were manipulating financial statements, inflating profits, and hiding debt, all while enjoying substantial personal gain. Forensic accountants played a pivotal role in uncovering this labyrinth of deception. When Enron's accounting practices came under scrutiny, these financial detectives rolled up their sleeves and dived into the murky waters of the company's financial records. Their investigation revealed a series of off-the-books partnerships and accounting sleights of hand that masked Enron's true financial health. This discovery was a bombshell, leading to a loss of investor confidence and ultimately the company's bankruptcy in December of 2001. The aftermath of the scandal was catastrophic. Thousands of employees lost their jobs and their retirement savings, while investors lost billions. The ripple effect was felt across the global economy, and it led to a significant overhaul of financial reporting regulations. Notably, the Enron scandal brought about the Sarbanes-Oxley Act in 2002, marking a new era of corporate governance and financial transparency. This legislation now requires top executives to personally certify the accuracy of their company's financial statements, with severe penalties for misrepresentation. But perhaps the most crucial lesson from the Enron scandal is the indispensable role of forensic accountants. Their expertise in dissecting financial records, spotting irregularities, and understanding complex financial transactions is paramount in the fight against financial fraud. They are the unsung heroes, tirelessly working behind the scenes to safeguard the integrity of financial systems and protect innocent individuals from becoming victims of corporate greed. The Enron scandal underscores the devastating effects of financial fraud and the critical role of forensic accountants in fraud detection and prevention. Forensic accountants employ a variety of tools and techniques to detect and prevent fraud. Let's delve into a few of these key tools. First up, we have data analysis, a powerful method used to identify patterns and anomalies within financial data. By examining these patterns, forensic accountants can spot potential red flags and investigate further. Next, there's ratio analysis. This involves comparing different figures within a company's financial statements. Inconsistencies in these ratios can often hint at fraudulent activities. Finally, we have the rapidly evolving field of digital forensics. As businesses increasingly operate online, forensic accountants are leveraging technology to trace digital footprints and identify suspicious activities. These techniques are not just theoretical constructs, they are applied every day in the real world by forensic accountants. From small businesses to multinational corporations, these tools are instrumental in maintaining financial integrity and trust. Armed with these tools, forensic accountants are well equipped to uncover even the most sophisticated financial frauds. Preventing fraud is just as important, if not more so, than detecting it. Forensic accounting plays a pivotal role in this effort. It's not merely an after-the-fact solution, but a proactive approach to nip fraudulent activities in the bud. By scrutinizing financial records with a fine-tooth comb, forensic accountants can spot the telltale signs of irregularities before they spiral out of control. But fraud prevention isn't solely the domain of forensic accountants. It's a collective responsibility that requires robust internal controls and ethical business practices. Internal controls, such as segregation of duties, regular audits, and stringent approval processes, can act as formidable barriers against fraud. Similarly, fostering a culture of ethical conduct can dissuade employees from engaging in fraudulent activities. The fight against financial fraud can seem like an uphill battle, but remember, prevention is the best cure. Forensic accounting, with its focus on fraud detection and prevention, is a powerful weapon in the fight against financial fraud.